Welcome to our YouTube live, and we're going to just go over some of the inflation numbers that we just had in the UK, because I think there's a lot of celebration about the fact that it's coming down, and I think if you actually look at the numbers, it's not quite so positive as many people are making out. So we'll go through the media coverage, and then we'll look at the actual numbers in a bit more depth, and then I'll give you my take on it, and then we can maybe have some questions at the end of it. So let me just get my Laura document ready, because she remote controls me via a Google document. And I'll move that over here, and we'll close down Slack. Very good. Right. So let me just start. So what I'm going to do is just kind of trot through this prezzo. It's pretty short, you know. We'll just kind of talk about the talking points, and then you can ask some questions. So let me move down here, maybe down here, no, over here, and we're off. So make this a bit bigger. There we are. Right, so this is a kind of media coverage that we've had recently. So this is from the BBC. It's talking about a big rise in interest rates from the Bank of England. This is the monetary policy response, and a big rise. In other words, instead of a 0.25% increase in interest rates, which is what central banks usually do, that's their default increase or decrease. Many people were expecting another 0.5% increase, because remember the latest rate increase was 0.5. So we're not going to get a jumbo move probably now. Maybe that's true, and we'll talk about market expectations in a minute. But certainly it's good news, right? Not such high inflation, and at the margin, yeah, the Bank of England's less likely to be so aggressive with its interest rate increases. So let's have a look at the result of that. Now, what most people are interested in, they just hear interest rate, or inflation. They don't care. Most people care about it because of mortgage rates. And if you look at the mortgage rates in the UK, this story, which was also published recently, was talking about the fall in mortgage rates. And you can see the headline, the strap line here is mortgage rates have fallen for the first time in 2 months, following better than expected inflation figures. So let's have a look at how much those inflation numbers fell. And you can see that it's absolutely tiny. So if you zoom in later in the article, it says the 2-year fixed residential mortgage rate dipped to 6.79% from 6.81. Now 2 basis points, I mean, at least it's not going up anymore as it had been until recently, but I don't think that's a particularly big move. So what material difference will this make to people's lives? Well, 2 basis points, not a lot. And the 5-year fixed residential mortgage rate fell by another 2 basis points, right, to 6.31 from 6.33. So certainly the markets, and these are based on swap rates, which are interest rate swaps, because that's how mortgage lenders swap. That's how mortgage lenders hedge their mortgages. They're not taking interest rate risk, they lay it off in this interest rate derivatives market. So the swap rate is what sets those 2-year and 5-year fixed rates, which itself is related to the gilt yield curve. So there was a pretty big move in yield curves at the 2-year point, but that didn't feed through into the mortgage rates, at least not yet. So perhaps this is a delayed effect, but it's certainly, I don't think that's a material difference so far, at least. But if you look at the 2-year yield, and this is a tweet from Mohammed El-Arian, ex-PIMCO guy, now Master of Queen's College, I think, in Cambridge. But you can see that the 2-year yield fell from just under 5.1% down to about 4.9%. And what we can also do is actually use Koifin. So let's have a look at Koifin, just to have a look at the rates in the UK. And of course, I got this ready just before this YouTube live, and you can see the effect of the kind of inflation numbers there. It has fallen a little bit, but recently it's kind of risen again. So as of the 20th, you can see the 2-year yield fell to 4.2%. This is when the data came out, the inflation data, but now it's edged back up to the close was 4.3. So yeah, there was a temporary movement, but I think a lot of people have realized that we haven't won this battle yet, and inflation in the UK is still sticky. So let's have a look at the so that was the kind of okay media coverage. This is the kind of shocking media coverage, and this really made me laugh because this is the cover of the Daily Express, and it says prices must drop now, inflation has fallen. But of course, inflation is a year-on-year change, so in order for prices to drop, you'd have to go to deflation, and we're way off that. So yeah, anyway, this is a really good case for better financial education in the UK, but really atrocious coverage, but amusing from the Daily Express. So this is the let's move that over a bit. This is the actual number that came out, right? So this is the headline number for the UK, and yes, it's way off the peak, which is above 10% at the end of last year. And headline inflation, that's when everything's included, that was 8%, and it was a fairly chunky fall from the previous print, which was disappointing because that had gone up a bit. And you can see that that was actually below expectations. So it's always interesting to see what people are expecting is going to happen, and this was below expectations, and that made it seem even more positive. But the thing which you've really got to pay attention to is core CPI. Why do we care about that, given that you've stripped out energy and food and alcoholic beverages and tobacco in the UK? Why do we care about core? Well, remember, if you're the Bank of England, it's like steering a supertanker. It's got a huge amount of momentum. You make a change in policy, it can take months, sometimes years, for that policy to affect activity and inflation. So what you don't want is a really volatile measure of inflation. It's like having a compass that's flopping around all over the place. What you want is something which is more predictive of future inflation, and that's why we focus on core. It's less volatile. We'll see energy prices in a minute, you'll see what I mean. But by stripping out those volatile components, you've got a more predictive measure of future inflation. And to steer your supertanker, that's what you want. You want something which is going to give you a better read on where the most important, well, maybe not the most important, but where inflation is heading. Now, that doesn't mean that they don't care about food inflation. Of course they do. They realise the suffering that causes for many households. But what they've got to do is find a number that's more useful for their monetary policy setting. And that's why central banks focus on core. Now, if we look at the contributions to that year-on-year change, these numbers add up to that 8% headline number. You can see the contributions, the year-on-year contributions from all the different components of UK inflation. So food is currently the biggest contributor. It contributes 2% to that 8% number. And the second biggest is housing and household services. Now remember, housing and household services, the prices went up there because of energy prices primarily. So obviously some of that is still feeding in on a year-on-year basis. If we look at transport, however, that's the only component in CPI inflation in the UK which is currently going through deflation. So the Daily Express will be happy about that. But all the other components are still positive, and several of these components, like restaurants and hotels, recreation and culture, goods and services, all of these are still contributing positively. Whereas if you look at the US consumption basket, it's roughly 50-50 if you look at the subcomponents of the ones which are now falling, and energy falling very deeply there. If we look at food prices in the UK, and this is a real pain point for poor households, remember, because there food is a much larger proportion of their expenditure. There we're seeing inflation fall to 17.3%. Now it was 19, so that's good, but it's still not great. I mean, it's just atrociously high, very close to that record high of 19% still. So clearly we haven't seen food inflation switch to rapid disinflation. That's a slower rate of inflation yet, and that's still a big contributor to the overall headline number now. If we look at transport, that was the component that went into negative territory, into deflation. You can see that has gone to minus 1.8% year on year recently, and that was after this horrendous spike, which was largely due to Russia's invasion of Ukraine. So at least that component is now lower. And this is going to feed through to energy prices. It'll feed through to that household component that we saw here, housing and household services. UK energy prices are set with this weird lagging cap system, but eventually it'll feed through to that. So we will see that start to normalise as well. But the food component's worrying. And as we'll see in a moment, wages also worrying. If we look at the CPI rate and we look at the contributions to the monthly changes, right? So this is how much the monthly contributions changed from May to June. You can see the effect of transport even more clearly. So here, transport is a negative component, a massive one. In fact, it's the main one. But what's also interesting here is if you look at the differences between May and June, food is now starting to turn downwards. So that momentum is very welcome. So there is disinflation in restaurants, furniture and household goods, and importantly food. So it is turning a corner, and that's really reassuring to see. Communication, still positive, maybe because of the crazy system we've got where many of the contracts are inflation plus some percentage, and clothing and footwear, clearly, as a fashion icon, that's a problem for me. Okay, and if we look at the UK compared to the rest of the world, this was particularly embarrassing last month. It's not looking so bad. Clearly, the headline inflation in the UK is heading the same way as other European countries, which is kind of what you'd expect. But it's still slightly difficult for the UK to be very blasé about this because we're still the highest amongst G7. We're still above the European average, and we're still above Germany, way above France, and miles above the US, where their comparable measure of inflation, which is this US hiccup measure, that's only 2.7% right now. So they kind of rose before everyone else. They fell more rapidly than everyone else. So hopefully what we'll see in the UK is a kind of lagged version of all these other countries. Maybe it's just a timing effect. That's what some people were thinking. If we look at core inflation, so this is stripping out energy and food, you can see that here the UK is really standing out amongst G7, amongst developed countries. So the UK is way above the US, it's way above Japan, of course, and it's way above the Eurozone in terms of core. So at least it did fall a bit. It didn't fall a lot, but it fell a bit. And remember, core inflation is driven much more by wages, and that's potentially problematic, as we'll see. Now, we saw the big fall in the 2-year yield with Mohammed El-Erian's tweet. I think part of that is that people were just far too bearish about, or far too hawkish about what the central bank was going to do. So you can see that this was what markets were pricing in, and just before we got this inflation data, markets were pricing in a 6.2% terminal rate. So that's the peak rate that you reach through this hiking cycle for the Bank of England. Compare that with the Fed, that's only 5.4. compare it with ECB, that's only 3.9. So people thought the Bank of England would hike longer and higher than all those other central banks. Now, the point with that, which is problematic, is that the UK economy is weaker than the US economy. We don't have such a positive outlook as the US. So it's more likely that we're going to get a recession and that we're going to have higher unemployment and slow demand and a slowdown in demand. So saying that we'd have a terminal rate which would be much higher than those other countries is kind of unrealistic. So probably those expectations were too kind of hawkish. So it's not all that surprising that when we got that inflation print, there was a much bigger move down, a big surprise move down at the 2-year part of the yield curve, which is very sensitive to policy rate expectations. So I think people were just unrealistically hawkish before the data came out. And if we look at the changes, so this is a tweet from Ed Conway, who kindly shares his Bloomberg terminal, which I can no longer afford, but he looks at the overnight index swap market, from which you can read what the implied rate would be for the UK. Now, before this inflation print came out, the market was pricing in that 6%, more than 6% yield for 6% bank rate. Now it's only pricing in 5.8. So not as bad as it was, but still, given that we're currently at 5%, that would still be 3 rate hikes above where we are today. So not as bad as people were expecting previously, but which was 1 percentage point higher than we were right now. Now we've just gone to like 3 rate hikes instead of 4 above our current bank rate. So it looks like markets are pricing in less hikes, but still more hikes than you'd probably like, particularly if you're someone with a mortgage. Now, why is this a problem? I mean, why is it that I think it's not cause for celebration? I think it's pretty clear that the wage growth that we're seeing right now in the UK is still pretty brisk. We've finally gone to positive real wage growth, which in a way is good, but in another way it's bad, which means, and that's because what it means is that we have got a price wage spiral in the UK, it seems. The labour market's still very tight. So if you look at the number of UK job vacancies per person who's unemployed, that got to an incredibly tight point, and that was at the end of last year, because as we came out of lockdown, there was a huge demand for goods and services as people went out about their daily lives again, and people weren't able to find people to fill the jobs. So the number of new jobs which were advertised increased a lot. There were less people in the labour market because a lot of people had left the labour market at that point and still have. And so this very tight labour market evolved, which meant that there was a huge there's a pressure on wages to rise at that point. It's not as tight as it was, that's falling fast, and that's good news, but it's still very tight compared to the pre-pandemic labour market. It still hasn't normalised. So that means there's going to be an upward wage pressure force behind CPI, the core CPI measure, which is the one the Bank of England looks at. And that's why I think it'll remain sticky until we see this realignment of supply and demand in the UK labour market. I don't think that tight labour market's going away. And that means that core inflation will stay high and the Bank of England will have more work to do. And you can see it more clearly. Unfortunately, I just checked on when these data were updated. 2 of the series were updated in April. We haven't had an update from the Office for National Statistics since then. One of them was updated in May. But what this shows is the number of employee jobs. That's the blue line. And you can see the post-lockdown effect was that just surged upwards as people needed to be employed, as there was demand for goods and services, more job ads went out. But if you actually look at the number of economically active people, that's kind of plateaued. It is starting to rise a bit now as more people are entering the labour market, but it's still not rising as quickly as the demand for workers. So that's it. I mean, that's my tuppence worth on inflation. So I do think it's quite sticky. I do think that we're going to have a rough time when it comes to hiking. I think it probably will be quite painful for the Bank of England to get supply of labour and demand for labour back into balance. And what it usually means is a recession and higher unemployment. So that's going to be painful for many people. You know, job uncertainty is not pleasant for anyone. But I think that's probably what it's going to take to get inflation back down. And I still think we've got a long way to go before that happens. So maybe not quite time to celebrate yet, is my take home. Okay, so back to you now. So here we go. And I'll fire up Laura's spreadsheet and I shall have a drink. And I'll also summon my dog at this point. Teddy. While you think of questions, I shall feed my puppy. He's not a puppy. Ted. Ted. No. Oh, here we come. All right. Ah, you came. Good, good, good. Treats. Yes. Very good. Yeah, so if you do have a question, please do like this stream if you're watching it in playback or now, because that helps us a lot and it's easy for you to do. And the algorithm likes it. And also subscribe to our channel if you like our content. And that way we can continue to produce good content. And yeah, share. Tell people about it so that they can watch it too. One more treat, Ted. You can't have too many. If only you could see his tail wagging. There we go. Good boy. Right. Yeah, so if you are one of our YouTube followers, one of our YouTube supporters, we'll see a little crown next to your name, and Laura will push your question to the front of the queue. And also, if you do a super chat, we'll also push your question to the front of the queue and answer it first. Right. So let's have a look and see what we've got. Okay. Ramin's quite bearish at times. Sorry, that was JJ. Enjoying a bit of a bull market at the moment. How long will it last? Good question. Oh, I think Laura's typing something. Yes. Mr. Hanlon, who's one of our YouTube supporters. Thank you, Mr. Hanlon. We appreciate it. He says, why do you recommend buying short duration bonds over long? Well, let's see if I can pull up a yield curve because I did quite a funky one recently. I'll see if I can reproduce it. Do you want to see me do some R coding live? Okay. You can't say this channel's not exciting. Okay, let me try sharing my screen and I'll move this over there. There we go. So hopefully you can see the R window now. Yes, I think you can. And we're going to get the UK yield curve. So I've just had to rewrite everything because I've switched to Windows. Goodness help me. Right, so here's the UK yield curve. So what I've done here is I've plotted all of the bond yields ranging from a maturity of 0, they're about to mature, all the way up to 50 years. And these are UK gilts. Now notice that they all kind of cluster around a kind of central line. That's because two bonds issued by the UK government with similar maturity will have very similar yield. So the return that they'll generate between today and the day when they mature will be very similar. So for example, if we've got, I don't know, T39 and T40, both of them have a yield which is very close to 4.4% as of yesterday's close. So that's all you really need to know about a bond in the UK is what's its maturity, and you pretty much know its yield. And you can generate that yield by buying that single bond and holding it to maturity. You can do that on many platforms in the UK. Interactive Investor's the one I use. AJ Bell's another one which has gilts, single gilts. Somebody emailed me this morning saying that XO, X-O, which is a kind of low-cost UK broker, they have it too. They have gilts as well. And Hargreaves Lansdown, of course, the most expensive platform in the UK, has gilts too. So you can buy these quite easily. I say quite easily. I made a video about it if you want to watch it. I've made a longer video for members just to show how it's done, because I don't think it's as easy as an equity. With an equity, a stock, prices just go up and down. With a gilt, you can see that time, maturity is another dimension you have to think about. Look, the reason why I'm saying that short-term bonds are good is because their yields are higher. So if you buy one of these, like T24, TY25, T25, TG25, all of them have yields which are 4.8% or higher. And the ones which are really short maturity were above 5%. I say were because who knows, after the inflation numbers came out, it's probably a different story. But anyway, that's the yield curve. And that's why I'm saying, it's probably best to go for the shorter end of the yield curve, because those bonds are now getting to the point where they get the pull to par. That means that the price very gradually starts to creep up back to 100. Doesn't matter where it started, above 100 or below 100, it'll creep back to 100. And so the yield there, the volatility there is very low, because once the pull to par really kicks in, the price volatility almost falls to zero. So very low volatility, pretty good return, almost no credit risk for the UK government. They're not going to default on their debt, let's hope. Okay. Yeah, you heard it here first. So, short maturity, very little duration risk, very little credit risk, and a very high return. And risk adjusted, the return's just crazily high. You compare that with stocks, where you might get 5% return over the next year, or you might not. So, that's the attraction of bonds right now. Good risk-adjusted return, particularly at the short end of the curve. And it is inverted, although you can see it's got a bit of a kink in it. I can't make my arm do that. I can't. But anyway, that's the shape of it. So I hope that's helpful. Right, Ned Flanders, frequent flyer on this channel. Thank you, Ned. And Ned Flanders has done a super chat. Thank you. Will high street banks suffer from now or not? Yeah, well, that kind of my video for this Saturday is all about bank runs in the UK and whether we could potentially have them. So I was typing. But yeah, I think in the UK, the story with net interest margin is currently it's pretty high. So just to recap, what is a net interest margin? The deposits that customers have with a bank are, if you just have money sitting in a current account, that's a sight deposit. That's what it's called, sight deposit, call deposit, because you can take the money out anytime you want. And the rate on that is very close to zero. And there's been a whole kerfuffle about, why is it so low? Why aren't you passing on the higher interest rates? Well, of course, they're not going to do that because they don't want to have too much of that runnable money. Why is it runnable? Because you could take it out anytime you want. And if everyone takes it out at once, then they could have a bank run. So runnable money is cheap funding, which is good for the bank, but it's runnable money, which is not good at all. So in the UK at the moment, we set the 85k guarantee for deposits in 2010. Since 2010, inflation cumulatively has eroded the value of that protection by about 1/3. Now, they didn't inflation link it, They had to keep it harmonised with the rest of Europe. Then the exchange rate changed, so they dropped it to 75. They raised it to 85 again. But it's been pretty much at 85 ever since 2010. And lots of deposits in the UK. By some estimates, about half of deposits in the UK are not covered by the FSCS guarantee. So think about it. If you hear a rumour on Twitter that your bank is not solvent, then even if it's not true, if you've got money above the 85k limit, which one third of, or one half, between one third and one half of UK deposits are not covered, then you take your money out or split it amongst multiple banks, so it's below the FSCS guarantee. That's the absolutely rational thing to do. So that's why I think I'm worried that you know what could go wrong in the UK. That's a problem for banks in the UK. So that's why I'm worried about UK banks. I think they could suffer deposit outflows. Now, a less extreme effect of outflows, deposit outflows, is that people will just see that they can get better interest rates elsewhere. They'll take their money out of deposits, they'll put it into hopefully another form of deposit with a bank, a 1 year, 2 year, 3 year fixed deposit where they will get a higher rate. That would be okay because it's still cheap funding for the bank, it's no longer runnable. That would be great. But I suspect what they're going to do is buy this yield curve, because if you can generate 5% with almost no credit risk and almost no duration risk, you would. The only thing that's stopping people doing this is lack of knowledge. And if I'm talking about it on a YouTube channel, it's pretty easy to learn, right? You just get a brokerage account and you buy one. It's not that hard. So I think the threshold for people to do this and to realize this is pretty low. So yeah, I think that the potential for people to take their deposits out and not do a term deposit with a bank is pretty high. And if that happens, then banks lose their cheap funding. They also have less deposits, so they can have less assets. And both of those make them less profitable. They either have to pay more on their deposits to attract customers. That reduces their net interest margin, which is the difference between the rate they pay you as a depositor and the interest rate they charge on their loans. Because remember, when you put the money into the bank, chances are it gets recycled into a loan for some third party. They don't keep the cash because it's very they don't keep a lot of cash because it doesn't generate a lot of return. They'll take your cash and turn it into a loan to a third party. So net interest margin will probably fall, I suspect, because of these higher interest rate. So margins will fall at UK banks probably. And if we do get a period of weaker growth, then, which is likely because the Bank of England is essentially engineering a period of weaker growth, not too weak but still weaker, then that's not good news for banks because they're cyclical. So I think that's a problem. So I wouldn't be piling into UK banks right now. I did buy a US ETF for the US banking sector, and that's doing pretty well. It's up quite a bit, not hugely. I think it's about 10%, something like that, since I bought it. Because after the prices crashed with the regional banking crisis there, I thought that good banks were being dragged down with bad banks, and as it turns out, that was the case, and there has been a recovery. So yeah, I think the US has pretty much solved their bank run problem because of the way they've structured their guarantee from the Fed. But anyway, that's what the US has done. Probably will end up doing something similar from the Bank of England. But I'm just concerned that there will be this period until the bank resolution mechanism is fixed for the UK, or they raise the deposit guarantee. They'd probably be loath to do that, but that's another solution. Until that happens, I'm still concerned about the stability of UK banks. Oh, and Eddie Ward just gave us a super chat to thank us. That's really kind of you, Eddie. That's really good. How are we doing for time? Let's do another 10 minutes, and then I'll go and eat my what was it? Broccoli soup. Yeah. Right. So let's have a look at some more of these questions. Do you want another treat, Ted? Anton says, sorry Ted, got distracted. I'm noticing a lot of grocery items are being reduced in the last few weeks. Not sure if it's seasonality or potential deflation on groceries forming up. Yeah, I mean, I hang out at the local grocery shop a lot. I just like buying fruit and veg from our local shop in Holmer Green. Nathan's Fruit and Veg, very good. And the prices, I've got to say, don't seem to have come down a lot. At least not at Nathan's. So perhaps it's just a Holmer Green inflation thing. But you can see there's disinflation. When we looked at the numbers, there's clear disinflation for UK food, and that's got to be a good thing. But still, it's at 17% year on year, so not great. But at least it is falling. Constant Fear says, let's see if this is similar to Damo's talk. Well, funnily enough, I just went to see Damo. Why are you stiffing my tummy? I just went to see Damo, and he just interviewed me for his podcast. That was a lot of fun. So I don't know if it's similar to Damo's talk. Oh, he did it yesterday. Oh dear, I'm a day late. Someone's saying, all this time waiting for Bubby. I think they're talking about you, Ted. He's Teddy. He's called Teddy. Aren't you? Yeah. How are we doing for super chats? Anything else? Yes, Mr. Hallen's got another question. In my previous question, I asked about bonds. I was really talking about bond ETFs. Long duration bond ETFs should rise more than short duration should rates drop. So what's the catch? Well, I guess if you've got high inflation, the problem is that if you look at which bonds hate inflation most, it's long duration. So in theory, you're right. If inflation's falling, long duration bonds should benefit the most, but they're much more volatile. So as news comes in about inflation, so let's say next month we get a higher than expected print on inflation, well then your bond fund is going to tank because long duration bonds are particularly susceptible to inflation. So it's going to be a rough ride. That's all I'd say. So if you do buy UK long duration bonds, that's a risk. That there's lots of volatility and you have to sell the fund just when it's during one of its crashy periods. The beauty of single bonds is you can completely ignore any movements in their value, because all you have to do is hold it to maturity and you automatically get your money back. It kind of sells itself, if you like, once it matures. So unlike a stock, in order to get rid of a stock, you have to sell it, you have to face the market again. With a bond, you don't. You just wait till maturity. So that's why I kind of prefer, when it comes to fixed income exposure, having single bonds. It's more effort and probably less efficient in terms of the bid offer spread, but I still think it's definitely got attractions, particularly at the moment. But you're right, yeah. Long duration bond ETFs, if inflation's falling, they'll rally probably more than short duration government bonds. The other point as well, which is interesting, is normally what happens is if stocks crash, long duration bonds rally more, because if the yield curve shifts down, because people are buying bonds because they're scared, because of the multiplier effect on the price of funds, if they've got longer duration, they'll rally more. Now that's normally what happens. Long duration bonds rally more when equities crash, when stocks crash, than short duration. And that effect will be bigger when bonds decorrelate from equity, which is what happens when inflation falls. So in other words, yes, the long duration bond funds will be a better hedge for stocks once inflation falls, and they'll be a big beneficiary of falling inflation. So you could get a double whammy if stocks fall as well. So there is that to consider too, the decorrelation between bonds and stocks when inflation falls. That's another thing to think about. Oh, and Alex did a super chat to thank us for answering his question. That's really kind. Thank you, Alex. Jeff Riley has a super chat. He says, Vanguard short-term bond versus buying individual bond. Yeah, I guess you're saying, which is better? Well, money market funds are great because they pick up higher interest rates very quickly, but that's also their downfall. So if interest rates start to fall, then they'll pick up that lower rate very quickly because they churn their contents very quickly. And so the instruments inside them, the interest rate changes very quickly. So if you buy a single bond, you're locking in the rate. You know what you're going to get. If you buy a bond fund, like a money market fund or an ultra short term bond fund, pretty much the same thing, you don't know what you're going to get. And it'll dynamically change as interest rates change. So while inflation was high and sticky, and interest rates were continually rising and rising, having money market funds was great. Once inflation peaks and starts to fall, and we get serious disinflation, and policy turns towards something which is more dovish, at that point you probably want to lock in longer duration. So there you could do that with a longer term bond fund. You could do it with a single bond which is longer term. But yeah, I think if you think interest rates are rising and you want something which automatically picks up higher rates, then a money market fund would make sense, a short-term money market fund or an ultra short-term bond fund. If you think interest rates are falling, not so much. There you want to lock in a rate, and you probably want to go further out on the curve to get lock in that rate for longer when rates are falling, I'd say. Right, what else have we got? How are we doing for time? Oh yes, a Daily Express comment, got to read that. Daily Express probably thinks that means we'll probably be getting paid to drive around. It was an amusing article. Wage is definitely worrying, but honestly can't blame Joe Public for demanding rises. Absolutely. If you're a doctor, even, they're pretty well paid anyway, but they haven't seen real wage growth for some time, for a decade apparently. So yeah, you can't blame people for asking for a higher wage. Absolutely, but the macroeconomics is pretty clear that that will maintain higher core inflation and not be good for. Oh, somebody's making a nasty comment about you, Ted. They're saying, good to not be listening to that dog smashing through those biscuits. Yeah. Nasty. Bring on the 7% mortgage base rate. It's for the greater good. Yeah, I guess. We still haven't seen a really big price fall for UK houses. And, so many people are locked out of the market now, particularly young people. And, yeah, I think that it's still unrealistic, the level of UK house prices relative to our wages. It's still not far off an all-time record, even after the falls that we've seen recently. Yeah. Let's see what else we've got. Okay, so let's call it an end. Let's call the end of it there. So thank you all for joining us. Remember, if you do enjoy our content, please do like and subscribe to our channel. And thank you for joining us. It's been great to have your company, and I hope it's been useful. I hope you've got a bit more insight into those inflation numbers, And don't forget, if you do want to learn about joining our community, just go to our website, PensionCraft.com, or I do one-to-one coaching. Again, on our website, just go to PensionCraft.com/coaching. And if you are a member, you get lots of members only videos, you get our trackers, which are members only, and you also get our chat application. So we can chat about markets anytime you like, or gilt, or anything you want to discuss, we can do that. So thank you all for joining us, and see you at the next live stream, which I think is next week. Take care, everyone. Bye-bye.